October 1907, the American financial system was collapsing. Banks were failing, panic was spreading across New York City. People were lining up to withdraw their money before it vanished. The stock market was in free fall, and the United States government couldn't do anything because there was no central bank, no Federal Reserve, or any institution to stop the collapse. So one man stepped in. J.P. Morgan, the richest, most powerful banker in America. He locked the other bankers in his library, refused to let them leave until they agreed to pool their money and stop the panic. He personally decided which banks would survive and which would fail. He chose which companies got rescued and which went bankrupt. For 1 week that October, J.P. Morgan was the central bank of the United States, and he saved the economy. But he also proved something terrifying, that the American financial system depended on one private citizen having a good day and being willing and able to bail everyone out. This is the story of the Panic of 1907, how it started with a failed scheme to corner the copper market, how it spiraled into a full financial crisis, and how it led directly to the creation of the Federal Reserve 6 years later. The panic started with two men trying to get rich quick, Augustus Heinz and Charles Morse. Both were financiers who had made money in copper mining and banking. And in that fated October in 1907, they hatched a plan to corner the market on United Copper stock. Here's how a corner works. You buy up as much of a stock as possible. When short sellers need to buy shares to cover their positions, they have to buy from you at whatever price you demand. If you control enough of the stock, you can name your price. It's market manipulation, but in 1907, it wasn't illegal. Heinz and Morse thought they controlled enough United Copper stock to pull it off. They started buying more shares, driving the price up. Short sellers would panic, rush to cover, and Heinz and Morse would make millions. This plan failed spectacularly. As it turns out, they didn't control as much stock as they thought. And when they tried to squeeze the short sellers on October 14th, the short sellers found shares elsewhere. The price didn't spike, it collapsed. United Copper stock dropped from $60 to $10 in a single day. Heinz and Morse lost everything. But that wasn't the problem. The problem was where their money had come from. Heinz controlled multiple banks. Morse controlled others. They had used depositor money to fund their stock scheme. And when the scheme failed, their banks were insolvent. On October 16th, the New York Clearing House, an association of banks that process checks, announced they would no longer clear checks for Heinz's banks. That's a death sentence. Heinz and Morse's banks collapsed, and thus the panic began. Why? Here's the thing about banking in 1907. There was no deposit insurance, no FDIC, no government guarantee. If your bank failed, your money was gone. So when people heard that banks were failing, they did the rational thing. They rushed to withdraw their money before their bank failed too. This is called a bank run, and it's contagious. The panic spread from Heinz's banks to other banks, then to trust companies. Trust companies were financial institutions that managed estates and investments. They weren't technically banks, so they had less regulation, lower reserve requirements, and operated on thinner margins. On October 21st, depositors started lining up outside the Knickerbocker Trust Company, the third largest trust in New York. Knickerbocker had loaned money to Heinz and Morse. Rumors spread that Knickerbocker was about to fail. The president of Knickerbocker, Charles Barney, tried to stop the panic. He went to the New York Clearing House and asked for support. They refused, saying Knickerbocker was mismanaged and they wouldn't back it. The next day, October 22nd, Knickerbocker Trust Company failed. It paid out $8 million to depositors before running out of cash and closing its doors. People who didn't get their money out lost everything. Charles Barney shot himself a few weeks later, and the panic went into overdrive. Trust companies across New York faced runs. The Trust Company of America, the second largest, had lines of depositors stretching down the block. They were paying out $1 million an hour. At that rate, they'd be bankrupt by the next day. The stock market was collapsing. The New York Stock Exchange was running out of liquidity. Brokers couldn't get loans to settle trades, and were the exchange to close, it would trigger a complete financial meltdown. On the 24th, the crisis hit critical mass, and in stepped J.P. Morgan. John Piermont Morgan was 70 years old. He was the richest, most powerful private banker in the world. He had bailed out the U.S. government in 1895 when the Treasury almost ran out of gold. He had financed the creation of U.S. Steel, General Electric, and dozens of other corporations. He was richer and more powerful than most governments. And in October 1907, he became the de facto central bank of the United States. He set up a command center in his library on Madison Avenue, where he summoned every major banker in New York. He organized them into committees. He reviewed the balance sheets of failing banks and trust companies and decided who would be saved and who was toast. On that 24th day of October, the Trust Company of America was hours from collapse. He examined their books and determined they were solvent but illiquid. That means they had assets but not enough cash to pay depositors. They could be saved if someone provided emergency liquidity. So by around 2 in that afternoon, Morgan had organized a consortium of banks to loan the Trust Company of America $8.25 million, which saved them. But the crisis wasn't over. The New York Stock Exchange was running out of money. Brokers needed $25 million in loans to settle trades and keep the exchange open. Without those loans, the exchange would close, and if it closed, panic would spread nationwide. Morgan had until 3 p.m. closing time to save the stock exchange. He gathered the bank presidents in his library. He told them they needed to raise $25 million in the next 15 minutes. The bankers hesitated. They were worried about their own reserves. Morgan reportedly slammed his fist on the table and said the exchange would not close. By 3 p.m., the bankers had pledged $23.6 million. Close enough. The stock exchange stayed open. But Morgan wasn't done yet. The city of New York was about to default. The city needed to issue $30 million in bonds to pay its bills. But with the financial crisis, no one would buy the bonds. If the city defaulted, it would trigger another wave of panic. Morgan bought the bonds himself, all $30 million. He personally saved New York City from bankruptcy. And there was one more crisis to handle. Moore & Slee was a major brokerage firm. They were heavily invested in Tennessee coal and iron stock. They had borrowed against that stock, but with the market collapsing, the value of Tennessee coal stock was plummeting. Moore & Slee was about to fail, and if they failed, they dumped their Tennessee coal shares on the market, crashing the stock further and triggering more failures. Morgan found a solution. U.S. Steel, which Morgan had helped create, would buy Tennessee coal. This would stabilize the stock price and save Moore & Slee. But there was a problem. U.S. Steel already controlled most of the American steel industry. Buying Tennessee coal would give them even more market share. That might violate antitrust laws. So Morgan sent his partners to Washington to meet with President Theodore Roosevelt. They explained the situation. If U.S. Steel didn't buy Tennessee coal, the financial system would collapse. Roosevelt, despite being a trust buster who had made his reputation fighting monopolies, agreed not to prosecute. U.S. Steel bought Tennessee coal, and Moore & Slee was saved. By early November, the panic was subsiding. Banks that Morgan had backed were stabilizing. The stock exchange was functioning. Credit was returning. J.P. Morgan had saved the American economy, single-handedly. But here's what that revealed. The United States, the richest country in the world, had no institutional mechanism to stop financial panics. No central bank, no lender of last resort. The entire system depended on one 70-year-old private banker being willing and able to organize a bailout. What if Morgan had been out of the country? What if he had been sick? What if he had an argument with his wife and was in a bad mood, so he decided not to help? The economy would have collapsed. That realization terrified Congress and the public. A modern economy couldn't function if its stability depended on one man's goodwill and willingness and ability to bail everyone out. In 1908, Congress passed the Aldrich-Vreeland Act, which created a commission to study banking reform. 5 years later, they created the Federal Reserve System, a central bank, a lender of last resort, an institution that could do what J.P. Morgan did in 1907, provide emergency liquidity to stop panics. The Panic of 1907 was the last major financial crisis in America without a central bank. Every crisis since then has involved the Federal Reserve stepping in to provide liquidity, lower interest rates, or bail out failing institutions. Whether that's good or bad is debatable, but the Panic of 1907 proved that modern economies need some mechanism to stop contagious bank runs and financial panics. Without it, a failed copper scheme can spiral into a complete economic collapse
in a matter of days. JP Morgan saved the economy in 1907, but he also proved that no economy should depend on one person to save it. That's why we have the Federal Reserve today. Love it or hate it, it exists because we learned what happens without it. Subscribe if you want more financial history that actually explains how things work and why they matter today.